Welcome to yet another Wealth Press Roundtable. I'm here with Lance Ippolito and Roger Scott, and we're here to discuss the goings on in the marketplace as usual. Roger, let's start with you. There's a lot of fear and trepidation surrounding the idea of the mortgage industry. And what is the risk? What is the opportunity from where you sit?
Well, here's the problem, and this is what I've been talking about this since last month, and we're already on the 6th of April. I still feel like we're in last month because there was just so much drama going on with the markets and coronavirus and so forth. But I'll tell you what it is, James. The Fed was very, very quick to try to put something together, this package they put together, this $2.2 trillion package, but they did not specify, codify, detail anything. So there's a lot of industries that are really mixed up right now in this, and they don't know what to do. They don't know how much they're going to be able to help. The details are not coming through fast enough. Okay, so let me give you a really good a good taste of this. Okay, so they were really quick to put together this act. It's called the CARES Act. Okay. And what it does is it codifies the law for federally insured mortgages and gives a foreclosure moratorium for 60 days and the ability to get a forbearance for your mortgage for up to a year. And from what I understand, they're granting them at an alarming rate right now, but none of this is really spelled out. For example, is the Treasury going to pay for this? Is the FHFA going to pay for this? Is the Fed going to pay for this? When is the money coming back? How is it all going to be organized? So because ultimately, the burden is not going to be on the people. It's going to be on these mortgage companies when it's all said and done. And they're going to have to figure out a way to get out of this. Are they going to get more security by the Fed? None of these pieces of the puzzle have been solved yet. You see, and there's a lot of questions. I mean, I could probably just sit here and off the top of my head figure out 20 issues that are involved with this. You know, for example. Is there going to be a tax issue because money's going to be given back to the original buyer of the property, the original mortgagee, or is it going to be a complete wipeout? In other words, hey, you had a loan of this amount of money. What are you going to have to show to get that benefit? How much of a benefit is it going to be? How is there going to be a panel that approves it? Is it going to be arbitrary? Is it going to be? There's just so many questions, and nobody's giving answers to any of this. And I mean, think about that. We're talking about 80% of people in this country not being able to pay their mortgage, and the Fed is basically saying, "Don't worry about it right now." Don't worry, we'll deal with it. Just don't worry about it. You don't have to pay anything right now. And the mortgage companies are like, okay. And the Fed's like, hey, you got to approve these people. We don't want to start a panic. So you're going to say, okay. You're going to say, okay. Just say, okay. And they're going, okay, we'll do it. We'll do it. We'll do whatever you want. But how are you going to make us whole? We'll figure all that out later.
Yeah.
That's what. And they're asking for emergency meetings this morning. They're like, we got to get to the bottom of all this. So there's a lot of questions that the Fed, the Treasury, all the different lenders, there's a panic. There's panic in the industry because of this right now. And I wouldn't be making such a big deal about this, but we're talking about the mortgage industry. We're not talking about, we're not talking about the school board. We're not talking about the airlines. We're talking about the mortgage industry. If the mortgage industry goes belly up, that's going to cause a whole other ripple and a whole other discussion for the market when we don't even want to get there. So so I'm very, and I was bringing this up last week. I was saying, well, the Fed is very fast to give this $2.2 billion, but they're very, very slow to explain all the details. So what I think is going to happen is, I think that all the positive, we're going to be saved by the Fed, all of that is going to start dissipating, and the particulars are going to start hurting us. Hey, when are we getting the money? How is it going to get the money? When are the hospitals going to get paid? When are the airlines? We're gonna get stuck in all the in the minutiae of the details, and
Right.
it's taking the Fed a very long time. Well, I don't know if it's a very long time. It's really not a long time, but in light of everything that's happening, we need answers, and we need these answers now. You're going to see a huge amount of mortgage fraud. You're
Yeah.
going to see a huge amount of tax fraud. You're going to see a huge, huge, huge amount of people being irresponsible with money, and we're going to find out about it after the fact, which is what always happens. So this needs to be resolved, and resolved now, before it starts putting another pressure on the market that we don't need.
Sure. Well, that's interesting because obviously the governments in the G7 are all sort of pushing the onus on absorbing the inability of mortgagees to pay, both in the commercial sense and the residential sense. And at this point, I'm looking at what happened in the UK as an example, and 90% of the mortgage investment funds have become closed. In other words, you're not allowed to withdraw your money from those funds, even if it was an open-ended fund prior, anymore, while they try to sort that out. Now, Lance, what does that equate to for you? You're seeing some interesting action from where you sit.
I
What's the
if you look at some of these REITs and mortgage related stocks, especially over the past 2 to 3 weeks, I mean, you've had some of them fall 40, 50%. Very alarming, which normally, they're very, very steady. They tend to not move too much, these type of stocks. So when you have these names that barely move 1 to 2% today, and they're falling 30, 40, 50% in a month, literally about a month, 4 weeks or so, it's definitely alarming out there. And I think one point, going back to the start of handling, and as Roger talked about, the Fed trying to take action, is there's been so much miscommunication out there between head of the Treasury and these large banks and mortgage companies, that I don't think, and we've actually seen reporters try to go into detail this, there's such a lack of communication that nobody really knows what the outcome's going to be. They just wanted basically to put a band-aid and send something out there to reassure the markets, which has been, it seems to be, one of the top priorities, if not the top priority, and to calm the stock market. But in reality, putting these band-aids over and over again, I think we're going to eventually get that band-aid pull off. And like Roger said, you'll see the result after the fact. Um, After the fact of the result of all this, so it'll be too late. um it's a scary time, because we're not getting answers, and I don't know if there is answers right now.
Mhm.
Huge question mark.
It looks like they're just doing it all kind of in real time, and just trying to put fires out as they happen. But you can't, and just think about this for a second. I'm the Fed, and hey guys, don't worry about it. We'll take care of it. Just tell folks they don't have to pay their mortgage. I mean, think about the gravity of something like that
you
down
know
the road. I mean, that's scary. I mean, that, excuse my French, but that blows my mind away.
And the crazy part was, originally, wasn't it just a month? They first came out with, we'll give you forgiveness for a month. And I think they actually did credit card debt too, where they mentioned something about that. And 1 month is a whole lot different, you know, than what we're actually seeing. Again, this is just, hey, short-term solution. Oh, you've been hit hard. Don't worry. We'll send you a check. You don't have to pay your mortgage for a month. You'll be fine. Now it's, whoa, we actually have some problems. Let's try to, calm the markets. Let's try to calm the American people. But really, we don't know what we're doing. We just want to give people some hope out there that everything will be okay. But we're not just talking about, oh, here's a little bit of money, band-aid on this little bit of money. I mean, we're talking we're talking about a boatload of money, and
Right.
not only
Right.
affecting us as individuals, but these larger corporations and just
And how about this? Have they told us how much of it is going to be a grant versus how much of it is going to be a loan? Did they tell us the terms? The, I- Maybe
Right.
I'm missing something,
I
but
mean,
I haven't seen anything.
when you can't when people cannot even go on a website to file unemployment, like Roger, I'm sure you've seen in the state of Florida, people have been complaining, every day about the website they can't get access to. There's actually paper applications now, and they say, well, we don't know exactly how long it's going to take. It will take longer, but there's no details on that. Um, you know, let alone the whole mortgage industry out there that, let's be honest, people have gotten over leveraged, especially in the past couple years, which, I don't want to look back at 08, 09, but, when people get over leveraged and they don't have that money that they used to have or that they thought they had, it can lead to some scary results.
Sure. So I guess at this point the government is trying to get everybody to not panic. Would obviously be the first sort of interpretation of the moves they have made. But by not giving details, they might be actually defeating that purpose because people are saying, "Well, great, you're going to look after things, but if you're going to tell me that, hey, we're just going to defer it, and I've got this future piling up debt after a period of no income." Then you've just kicked my personal financial crisis down the road a bit, and that's really no help. The bank is still going to end up owning my home, or I'm still going to get turfed out of my rental property, and and then that all filters back up the change into the investor channels. You see the funds being gated, the funds values collapsing in real time. What is a better solution?
Well, that's a good question. A better solution would have been to, the truth is hindsight is 2020, and we don't know if it would have been a better solution, but I think a better solution would have been to take the heads of every department of the Fed and have them make temporary rules before offering or committing an X amount of money. In other
Right.
words, saying, we'll offer you this assistance. This is how we're going to do it. This is the plan. And then as things get worse, saying, hey, we're also going to back it up by $2.2 trillion. That would have been the way I would have done it personally. Because saying, hey, don't worry, we got you covered. We got $2.2 trillion. We got indefinite help, indefinite. Well, what does that mean, indefinite? That means taking money from Peter to pay Paul. How much is that going to increase our deficit? You know, are, is this a permanent solution? Is this a long-term solution? Are you just going to start printing more money and devaluating gold in the US dollar even more? I mean, maybe these answers are good enough for people who have very little financial understanding, but
Right.
for guys
Right.
who kind of know what they're to look at, this just this creates more problems than answers for me. For let me just give you Donald Trump's business properties are suffering. We've learned. Is he going to be subject to the same exemptions? Is there an interest issue there? Because obviously he's the president. He's voting on all of these things. It's going to be used to bail out his hotels. Is there a conflict of interest there? I don't know. Nobody knows. Did anybody think about that when they were creating this 2.2 trillion? I don't think so. There's just so many factors involved in this, and that nobody's talking about them. And I think this week, next week, the week after, all these little things are going to start falling out. Are going to be these questions are going to come to fruition. We're going to start figuring out, hey, um, when when are these mortgages going to become due? And do we have the liquidity? How much more interest rate? How much more liquidity we have to provide for the bond market not to go belly up? And I think as we will the global markets cooperate? Will Japan, for example,
They just
I don't know if you guys heard, but
yeah.
Japan was trying to do the same thing that England and the people in London and England were trying to do, to not really protect themselves with this coronavirus, not to quarantine themselves. And now it's
Lockdown.
backfired. You've heard of that? Yeah.
Yeah. They're all
And
Abe came out and said, what do
yeah,
they do? 30 days?
yeah,
They're
yeah,
starting?
yeah,
Yeah.
yeah. So there, we really are not. We are not. What basically, I think the answer to your question, James, is we are in a practical sense in no better place than we were 2 weeks ago. We now have just more questions, but we don't have any answers to anything. And I think that's very, very fearful. That's very, very scary. Because eventually the things that I'm seeing, the things that you're seeing, the things that Lance is seeing, the questions that we're raising, you're gonna have CNN talking about these questions. And the problem is there's no answers. There is no answers. And this is not going to happen a year from now. This is going to happen a day from now, 2 days, 3 days. This CARES Act that I'm talking about, these issues, it's a major issue that's happening this morning. The all of these different leaders of various mortgage associations, they're demanding a meeting this morning to get the answers to these questions. What are hey, what are we going to tell people? How long are we going to give them a break for? What's the consequences going to be? Hey, government, are you going to save our butts when we write our last check? We don't know. They don't know. So as we start getting clarity, we're going to start hearing a lot of things that we may not want to hear.
Right.
And we're not going to the whole, hey, we're going to be saved by the Fed. Well, it sounds really good. Let's really see what that means. I think that's what's going to start coming out. And I think that the initial happiness or the initial relief of, oh man, thank God for the Fed, is going to be kind of like, hey, are they really helping me, or are they just confusing me and just prolonging this pain? And I think we're about to get there.
We've already seen that too, as details are starting to come out about the $1,200 checks, that now people are, everyone assumed, well, everyone's going to get $1,200, families 2,400, kids 500. Now details are coming out. It was actually on the cover of Yahoo Finance this morning. This is who will not get
Right.
the $1,200 check, and it may surprise you. And then it goes over all the criteria. So it's like, wow, everyone thought they had $1,200 coming in. Now you might have 20 to 30% of the people not getting that money,
Right.
as details get revealed. And I think coming from if you look at, let's say, ordinary people not in the finance industry, they think, hey, the Fed is the government. The Fed can print as much money as possible, and I don't have to pay my mortgage. I don't have to do this. I'll be fine. Just give it time. But in reality, that's not going to be the case. And if you have people not paying their mortgage, let's say 2 to 3 months, let's be honest, people are going to forget. They're going to become lazy. That 2 to 3 months is going to become 6 to 8 months. Next thing you know, they get a letter, they get a phone call. Oh, I'm behind. I didn't do this. Well, I can't pay it now. I've spent my money elsewhere. And then we start having that effect hit the mortgage market.
So is in your guys' opinion, is there any other outcome possible other than a massive round of foreclosures in the future in both commercial and residential real estate?
Well, in commercial, I think it's almost a certainty at this point. Um,
Yeah.
Again, you're going to have you're going to have a lot of industries that are no longer leading. You're going to have a lot of the structure of the not the U.S. The structure of the global business model is going to change. This is going to have a fundamental change for example, I think the value of the internet is going to be in line with the value of utilities after this is done. I think technology is going to be looked upon as a necessity after
Right.
this point versus a luxury. I think there's going to be a fundamental separation between consumer discretionary. You see, up till now, if you look at internet companies, and if you look at a lot of companies, I think we've put all of internet into consumer discretionary. I think after this, you're going to have how internet is used as a means to help people live their daily lives. I think there's going to be acts. Government's going to make specific internet acts, privacy acts. I think there's going to be networks and channels that are specifically made for emergency broadcasts on the internet. The bottom line is, I think the way we looked at railroads 100 years ago, we are going to start looking at the internet. The internet is going to become a means. I think we may even have a separate uh, sector in the S&P 500 for that. But I think that technology is not going to be equated for the first time in modern history with entertainment and fun and deluxe spending when people have money. I think the internet is going to be a fundamental basis for education,
Right.
for services, for communication. I think the internet after this will never be looked upon the same way again in
Sure.
history, in the history of it as we know it.
Okay, so now let me ask you this. Why is the Dow up 1,000 points today if there is nothing but bad news out there?
It's a good question. Let me answer that question, and I'll have Lance answer that question if that's okay. If we'll take turns, because this is opinions, obviously.
Mhm.
My opinion is, and I'm only going by based on what I'm seeing and reading, is the the world markets um, are not being guided by the future. They're being guided by what is happening right now in light of what we're expecting in terms of deaths. It's a very morbid way of looking at things, but the markets are concerned with literally right now. Um, the things that the markets are trying to determine right now is whether the number of deaths uh, continues or begins to flatline. And if that flatlines, that means conditions are getting better. Then this coronavirus will not be here as long as we're potentially anticipating it right now. There's some hope that that is happening over the last few days. That curve is flattening. Less people are getting sick. People are recovering faster. That number that Trump threw at us last week, 100,000 to 240,000, I think everyone has that in their head, and I think the market assimilated that in its value last week. I don't think the market is looking ahead too far right now into all of these things that we're discussing right now. I think the market's too busy figuring out how many people are going to die from this in the immediate future. At least that's what I'm seeing right now. And if that number continues to improve, if that curve flattens, we're going to see more upside. If that curve gets worse, we're going to see a decline. But I think ultimately the markets, after this is resolved, and after there's a cure, then the market is going to turn to all of these factors that we've been talking about during this meeting.
Hmm. Okay, well, so I mean, the U.S. is, at 337,000 cases. I'm still at a loss to explain how that results in a dramatic up day of 5% increase for the Dow and the S&P. It just seems to be so counterintuitive.
Look at the number of deaths. How many deaths have we had?
Well, today 36.
The market is assimilating as of last week, by the end of this month, about 100,000 to 240,000 deaths. That's what the market is assimilating in its value as of Friday afternoon. Any number, any news that's better than that will cause a rally.
The market is headline driven right now. Any
Completely.
positive headline, you're going to have short term pops, and negative headlines, short term drops. It's very fragile. And let's be clear about that. People have said, are we going to have a U shaped recovery, an L shaped recovery? That's a discussion, I think, for down the road. But right now, the market is looking at that headline news. But on the flip side, because the market is up about 4.5% today, Jamie Dimon of J.P. Morgan came out and he warned, about this will be a, a deep recession. He warned about guidance with J.P. Morgan. He spoke about how the bank was not prepared for something like this. The U.S. was not prepared for something like this. It was very gloomy. To be clear, the letter that he wrote, and that's if that happened 3 months ago, a note like that would tank the markets, especially coming from Jamie Dimon, who out of the top banks out there, he's been very vocal, and he's been right a lot of the time out there. Um, when looking at the markets out there, that would have really hurt us. But that came out today. Obviously markets are up short term today, but in my opinion, that was someone who has knowledge in the industry, um, really putting a dark outlook, in the next 6 to 12 months on the U.S. economy. So if you haven't looked at it, you could just Google Jamie Dimon. It will probably be on all the top headlines today. But that, in my opinion, was something that was a little shocking, and the markets haven't reacted to that. They're reacting, like Roger said, the death rate. And then it looks like Spain and Italy had a decrease in cases over the weekend as well.
And also keep in mind, we have a lot of short covering. A lot of
Right.
the reason that's one of the reasons why the market is up. We have a lot of there's a lot of people looking bargain shopping right now. Volatility is still near historic highs.
Yep.
So we're not out of this just because we're fluctuating. The fact that we're fluctuating and the fact that we have a lot of volatility, that's actually very positive. That means the market is still very emotional. And if a market is very emotional, it'll tend to bounce a lot more up and down. I would be a lot more concerned if we saw the market stay at these levels and volatility just died, because
Right.
that would mean, yeah, because that would
Yeah.
mean there's very little emotions in what's going on right now, and people are really basing their buying and selling on fear. But right now, James, the markets are totally driven by headlines, um, minute by minute news,
Yep.
and innuendos. And this is why, see, the way I'm trained, I'm always trying to look 2, 3, 4 steps ahead. So I'm looking to see how the market's going to react to all of the fallout that's going to happen based on what we're seeing right now, not on what's happening right now. I think this is just drama. And this is because look, we're the word I've been using for the last 3 weeks has been we're in a moving target right now. We don't know the death rate. We will not know where we stand till we peak out. So everything that happens between now and the time that we peak out, whenever that may be, is complete speculation. But the market wants to speculate right now because there's just so much volatility. So I think it's a combination of all of those factors.
The goal, and what I always say is, the goal is to be proactive, not reactive. Especially when you're talking about trading and investing out there. Um, you know, you see the market up today, people are going to think, oh, markets are safe. Let me go and buy stocks, right? So you're buying stocks on a 5% up day. That's a reaction. That's what you don't want to do. Especially, if you're holding positions or if you're investing down the road, you really have to think proactive. What is the end result of this? And then make your investment and trading decisions off that, depending on your time frame. But yeah, right now, markets are going to be driven by that headline news. We could be up 5% today. We could be up. We could be down 5% tomorrow, just like that.
All right, guys, let's leave it there for now. Great insight as usual. Thanks for joining me again today, and we'll talk to you later on in the week.
Thank you for having us, James. Really appreciate
Thank you,
it.
James.